Alright, this is like my fourth time doing this video, and I was wondering why, and I think I found out why. I don't think I've ever said any of this stuff out loud. I've always done it in my head or on paper or wrote it out, but I don't think I've ever done like a class on it or ever talked to somebody else about it. I know it sounds kind of weird, but it does make a difference in how smooth you talk about it and how together your ideas are and stuff like that. So, somebody asked in the chat of or in the comment section of one of my videos if I could go over the options that I do. I did mention I do some options. I actually had a whole nother YouTube channel dedicated to options, but I did daily trades, and I did daily option trades, and people were like keeping up with me and stuff like that. But that's totally different from how I do now. I did 18 months, or maybe a little over 18 months, where options were my or my main income, which is pretty rough sometimes, and I describe it as going to work climbing a sheer cliff with just your hands. You'll fall at any moment. Every single, trade or every single handle is extremely difficult, and just you could just fall at any time, and the stress is crazy, and it's just unrelenting. So that's why I don't do it very much, but I'm happy to share what I know. So first thing is, when you're trading options, you have to do them on stocks that you know, and that you can that you maybe want to own, and that are quality stocks, because what ends up happening is people chase the return, or they'll look for option screeners, and those will be the highest implied volatility, which are going to be like the riskiest stocks, which may may do good for you a little bit, but not on a consistent basis. You're not going to get a lot of consistent wins that way, is what I found. And since it was my income, then I was mostly selling for premium, selling cash secured puts, selling covered calls. I would sell credit spreads, credit call spreads, credit put spreads. I did some iron condors on SPX with some relatively success there. I didn't like that. I was playing both sides on the iron condors. I like to just stay with one thesis, because iron condors have two sides to them. They have the upper and the lower, and at any given time, if it hits the lower, then you win on the upper, and it's just a whole thing. Anyways, I'm not going to go through those. Those are entirely separate videos. Those are pretty complicated, and they have their own set of metrics. So what I'm going to do is just go through what I typically did. So I had a list of about 20 stocks, and every other week or once a month I would go through and I'd get rid of the stocks that had too low of premium, or that were not quality stocks anymore. They got downgraded, or something in the news, and I would take them out. I got ripped on a couple of them against my better judgment. I'll tell you about those. Those were Snap, I got ripped on. Walgreens, I got ripped on. A couple other bad positions I got ripped on, and those are just my fault. They just Snap. I shouldn't have even been dealing with that stock. And WBA was a Dow stock, and as soon as it dropped off the Dow, I should have got rid of it. But anyways, water under the bridge. So let's look. So if you don't have stocks yet, if you don't have like quality stocks yet, what I would do is look at one of the analysts and see, like, what are some decent stocks. You have to, when you're selling for premium, you have to be very aware of what it may cost you if you have to buy the stock or sell the stock. For instance, if you're dealing with a with a $5,000 or a $500 stock, you have to afford to buy $50,000 worth of that stock. A lot of people can't do that. So stock price in options is a huge deal. I would do, my shares would be, I would go maybe $65 and below, because if one went against me, I would have to do, 65 on the max, 6,500, which is not that bad. On the low end, I think 10 or 12 was the lowest that I went. But the premium on those isn't a lot, just because of the size of the stock price. So you have to really drill in on what you're investing in. So there are buy right ETFs that I like to do those ETFs instead of doing it myself. I'll show you a couple of those. This one is the one with Berkshire Hathaway. It's their derivative income ETF. I think it just came out like 2 months ago. It's done quite well. But what I do is, these guys are the top of their game, right? So what I do is I look at the stocks that they're trading. Bank of America, I've done that one before. You know, Verisign, not so much. I've done credit spreads on Apple. American Express, not so much. Coca-Cola, yes. Visa, yes. But these are stocks that have high prices, so you may not be able to. Those may be prohibitive in terms of stock price. Bank of America, I can't remember what their stock price is. I haven't dealt with them in a while, but I did look at Oxy. This one is interesting to me, and I'll show you why on the chart. So I pulled Oxy as an idea. Also, if you look at other buy rights like JEPI is a buy rate that I own. See what their stocks are. So yeah, very similar. They got Amazon, Nvidia, Lowe's. That's an interesting one to trade on. Got the Visa there. Analog, interesting. What are some other buy rights? Handy dandy thing here. Oh yeah, okay. I forgot for a second. LP or GPIQ. It's another buy right from Goldman Sachs that I recently started investing in. Nvidia, Microsoft, Apple, Broadband, Amazon. All the same ones, all the same. This one has Netflix. You can see the distribution yield. That's good enough for me. I don't want to be all stressed out trading options every day. But just go in, see some derivative income ETFs, see what they're trading, and then kind of pick your stocks from there. Or you could go all the way down to bare bones, and this one has Costco in it. Go all the way down to bare bones and do it yourself. But I would recommend vetting the stocks. So let's look at Oxy, which I pulled from Berkshire Hathaway. This is the 1 minute. Let's look at the 1 day. So you can see it's on an uptrend here. This chart doesn't tell us much in terms of options, but this one, it tells a story here. So we have some downward trend here. So this was probably a covered call strategy. Would have probably worked on a declining stock because they weren't going to trigger, and then this event right here obviously turned it into a cash secured put strategy. And you can see here, if I was doing cash secured puts on this, none of them would have triggered. Maybe around here they would have triggered. Took a couple weeks and it was here down under 42, may have triggered, but then your other ones probably not. So what would end up happening is I would have traded a cash secured put here, probably would have got assigned at the end of the week. I'd have to check what these weekdays are if they're a Friday. And then I would have turned around, sold the covered call, and it probably would have triggered a week and a half later. So that's how I would have done it. It's called the wheel strategy. If anybody's interested in looking up the wheel strategy. So we could look at premium here. Looks like maybe it's hard to tell here. Let me zoom in a little bit, see if I can see something here. Oh yeah, this one's better. If you look right here, around 40, 45-ish. You got this right here around 45. You got some resistance here around 45. Um, uh, 45 there, and then 45 there. It created a bottom there, or support right there, bounced off of it, and it looks like it's coming back into that 45.50 level. So I would say that that would be my price. Let's go to trade. So these are the weekly options. These ones expire this week, so the market's not open. I was trying to do this video while the market was open, but if you look here, these are cash secured puts. Here at 45 is $28, 45.50. It's $45. That's a 1%. That is right in the wheelhouse of where you want to be. So I get $45 for selling a 45.50 strike price. It's right there. If I want to be a little more conservative, do the 28. But see, it's only about 20 cents away, so you'd have to be pretty convicted on that 45.50 to collect that premium. But if you like the stock and you think it's going to bounce off that level, just get assigned and then sell the. It gets a dividend. I think it's 2.5 in there, and then sell the covered call until and collect the dividend until the covered call triggers. Do those weekly. You can see if it triggers at the 45.50 level, and let's say you did a covered call at 46, you'd get $26. That's closer to a 0.5%. So if you get 1%, 0.5%, 1%, and you do that on a weekly basis, you're talking about massive returns. The biggest deal with those is with like this kind of strategy is you have to have some stop losses. You have to have some stop losses. You can't just go down with the ship. So for instance, let me show you on a different stock, one that that I did a lot of premium selling on. This is MO Altria Group. You can see here it has a bit of outliers in terms of price up and down, but for the most part, it stayed right in here at the 60 level and 50, between 57 and 60 for a very long time. So this one you'd be able to sell cash secured puts, and then this one got assigned, sell the uh, sell the covered calls, probably trigger out right there, get assigned the cash secured put. So this is a good one to just roll over the strategy. Get the stock, collect the dividend, sell the call, get that assigned, and then just keep on doing it. And then here, if you did a cash secured put here, and let's say it triggered and you were assigned, you do the covered call, and then what would end up happening is you would, as this is going up, you would have to get closer to the strike price in order to get any kind of good premium. Because I would say if when I was trading this, and this just happened in August, so I was trading this, I got all my shares assigned. I had, I want to say 400 shares of this, and I was redoing my cash, my covered calls, and I had to sell out of like a ton of shares. I had to sell out of most of my shares, and then it's coming back in right here. So I could do one of two things. I could either buy the stock outright and sell covered calls again, or I could do cash secured puts at a level that I want. I would want a 60 level, even better. I would want a 58 level. Bring it back into where I'm comfortable with it. Let's see what those premiums are. Cash secured put at 59. See, there's no premium there. Let's see. cash secured put, I would have to do it at 63, and see that's already pretty close to the strike price. Because what would end up happening, if it comes all the way back down into this level here, into this 59, which is been its normal range for a very long time, then I would be stuck with shares at 60, and then I would have to do the cash secured puts again, or no, I'd have the stock, I'd do the covered calls, and then I'd have to sell for premium. And then if you look here, there's not very much premium for those covered calls. So the cash secured puts actually have slightly better premium than the covered calls. So again, you'd have to get the stocks that you're comfortable trading. You know what to look for. So I mentioned credit spreads. So what you can do if you don't want to buy the stock outright, when you get your cash secured puts, then just do a protective put. So for instance, you could do let's say you buy actually, let's set it up this way. Let's say you sell the 63, okay, and then you buy the 60. So if you, this is a vertical, so if you sold the 63, bought the 60, you'd make 23, which is the difference between this premium and that premium. But if this went against you, you would only lose the $3 a share. You wouldn't have to actually buy the stock. But you know, those work. I would use this strategy more on like very high stock prices, very high strike prices. Makes it a little more worth it because you know you can't shell out 50 grand to buy, the 100 shares. So you do the protective put on it, or the protective call. You could do this on the call set as well. Collect the premium. It's going to be much higher premium just because of the share price, and then because the share price is related to the premium level, and you wouldn't have to buy the stock. You just have a one-time loss of the difference with the share prices. You could even bring this in a little bit, but it's going to mess with your premium. Let's say I don't want to lose $300 a share. So let's say $200 a share doesn't go down that much. It's probably a better trade right there. You'd put $200 on the line, and then for $20 premium, again, that's a 1% return. You can do it that way. The problem, like I said, with this is it would only take one or two of those triggers to actually ruin your trading month. Whereas if you just had the funds to just buy the stock outright, you can reverse it, collect the dividends, and then do the covered calls, and you wouldn't take any losses on that. So I mean, you have to get used to what your strategy is. I have some people that hate selling and they only buy. They'll spend like $200 a week buying way out of the money stuff and just hope they swing and hit. But I would compare this to people selling for premium. You're going to get a high ratio of hits and very few losses if you do it properly. Whereas the other one is almost like a scratcher. You'll have a lot of losses, and you may have like one or two big wins that would cover all your losses. So it's almost like doing scratchers. If you guys have any of those lottery scratchers, I'm doing it more the Circle K way. I'm selling a lot of them, and I may have to pay out one or two of them. Whereas buying them would be like the customer, and they go and buy them, and they get one for like $1,000. It covers all of their losses that they've been accruing for the last 6 weeks. So yeah, that's what I do. That's my strategy. Like I said, I also do SPXs too. I do iron condors on SPX. Those are a little more tricky, especially in a market that's not coming down. And I could do a separate video if anybody's interested in that. So that's my strategy. I'm about 20 minutes in, long video. All right. If you guys have any questions, I'm here.